Hello, this is Coach Mike from winningstockcoach.com. Going to get started with my weekly market overview video. Market overview video for the upcoming trading week, the week beginning March 9th, 2015. Just a quick note, we had a S&P shorter term swing target up around 2101. And again, we came within a 0.5% of that for our 54th consecutive within a 0.5% market target. Pretty exciting. Just since 54 is just since I've been doing these videos. Last week we talked about watching a support point 2088.77 and not really feeling the need to go short until that failed, and then taking a shorter term approach at our shorts, meaning not really having high hopes that they keep falling very long until the chart started looking bearish overall. Should that 2088.77 fail. Now, in our chat room with the members of the coaches roster with winningstockcoach.com, those shorter term trades really didn't set up and evolve well for us until Friday, in which case we actually day traded a whole bunch of different put strikes on the SPY, the tradable ETF for the S&P 500, and did very, very well. We have a couple short trades that are heading into these upcoming couple weeks that, right now, what we really have to look at is a few points that I talked about last week. We still have a weekly swing high point from this consolidation, really the consolidation range break point of 2051.82. That's not saying we can't put prices below it during the week, but we're looking at a weekly chart, which means it takes an entire week for the candle to close. And so long as that candle closes above that point, we would have to expect a market bounce and the next series of long trades to develop. But we could also still see 2035.87 or 2006.94 based on the system we use for targeting prices, and still indeed remain bullish overall. One thing we need to watch right now is I think that any shorts you might be trading, short trading is trading for a downward direction in a stock, whether it be through put options or shorting individual shares. I still think you don't need to look too far below in too long term. I think that you need to be understanding that there's a high likelihood in this bullish market that you or I or anybody else probably still can't rationalize why we keep going up, but it's a fact. We keep going up. We keep making higher highs, and with the exception of the September October debacle where we got a weekly lower low, we kept making higher lows as well. So we have to keep that in the back of our minds that if we get into these two areas here and start to make a positive move, we could just be seeing what we've seen every single time. Now, if we do get below those levels and really below 1972.56, then we definitely have a lower low. And we still, ironically, need to keep a short-term approach at our short trades. Why? Well, this chart should show you pretty clearly that stocks don't go straight up or straight down. In fact, if all they do is go straight up once and then come straight down once, they're not worth looking at. Usually those are your pump and dump penny stock scams. Real stocks have a series of up and down movements. And what we would have to look at if we make that failure is before we could establish that a new trading channel or trend has been established, is you need both a down and an up move. So even a failure down here could be a fairly quick, and I'm not meaning a single day or a single 15-minute candle, but it could be a shorter term downwards move that then bounces upwards to give us what we would have to be looking at, which would be the subsequent high, to see if it's higher or lower than this one. Because if it were lower, we would have the means to establish a new trend or channel and the means to then take a longer term approach at short trades for a downward direction. Until that time, you've got to have a shorter term approach because that's where your higher probability opportunities are. And if you're using the options to produce those shorts via put options, then you would want the shorter term for the higher volatility in those options. You would make a greater profit on a quicker move that you weren't trading several months out for, so that you would also be observant enough to say, hey, I might need to sell this real quick and watch for the next up move. Because if we make a lower low and shoot up for a next up move, there's no telling where that lower high could be. It would just be an anticipation that we would indeed make a lower high. because it would then be a higher probability of a lower high being produced. But until that time, let me stress again, we need to still look at these areas of 2006.94, 2035.87 as potential bounce points from which we could just continue doing what the markets have been doing since March 2009 when they bottomed after the last market crash. And that would be continuing in a lower volume uptrend that each subsequent up move has lower and lower volume overall on average market wide, but is still indeed moving upwards. And that would be the fact that we would have to make our trades congruent with. We're going to move over now to the DJI weekly chart. This is our Dow Jones Industrial Average. Again, last week's weekly swing high point that we had talked about as a support level, got to delete it because we closed below it. We hit within the 0.5% of our target area. I've got it deleted off my chart now, but now we've got to watch for a pullback around that 17,485 or 17,222, both of which would still be indications of further bullishness if we got a positive move from them. Should we fail this level, 17,037 bucks and 76 cents, just like the plan for the S&P, shorter term short trade still waiting for a bounce opportunity that might produce then or have a greater probability of producing a lower high before you would go long term in your shorts. Right now, personally, regardless of what Monday does, it might go up a little bit just to fake us out a little bit. But I would still believe that so long as we stay below this weekly swing high point for the Dow, which is 18,140 and 44 cents, that we would continue downwards overall, even if we don't for one 15-minute candle or one day even, that this weekly chart would still continue downwards into one of these target areas. That doesn't mean long-term investments that you're holding you need to sell. If you've been holding long-term investments through each one of these series of higher highs and higher lows, then you need to still hold unless it gives you a lower low. And I would even say just to use that lower low to protect that long-term investment via in-the-money put options, which give you a right to sell shares at the strike price and would protect you for a difference between whether we just did what we did late September, early October, where we got the head fake on the lower low and then bam, all new highs, or to allow you the time to still establish whether, hey, it's time that we're going to keep going downwards. And it would give you the time to still hold those longer term investments without worrying about the rockiness of the volatility that could occur, while still giving you the right to sell those shares at a specific price. So I don't really see the need for panic, even if we were to fall below there. But I think if we were to fall below there, it'd be something we'd be talking about in next week's market overview video. Not really something I can personally see happening as part of this upcoming trading week. We're going to go over now to the RUT. That's the Russell 2000, our small cap index. Again, here was our long target for this last upswing, 1238.33, and we came within 0.5% of it. But we didn't fail the prior weekly swing high support point at 1215.21. So before we get antsy on small cap shorts, you've got to wait for this level to fail. And then even I think 1173.18 would be the lower end for a shorter term short swing or short position. I still think you'd have to keep the shorter term mentality. In reality, though, small cap stocks, by the way, they're not determined by the price per share. It's the market capitalization. They have not really been too exciting up or down for me lately. And I think that the patterns that we've seen, the longer term consolidation we had for a couple months, a couple little spikes, whatever, not really breaking out heavily to either side, have made it so I really don't have an interest in watching small caps right now. There's a lot more volatility in your large and mega cap stocks, in your S&P 500, your Dow Jones Industrial Average stocks that are producing better trades. Better trades. Trades are different than investments. And what I would really look for with the RUT is because, real traders know that trading's not about trying to call every high and every low. People that are infatuated with that usually are also infatuated with what they're doing wrong and why they're not making any money. It's about using confirmation moves that produce a higher probability at larger profit trades and using that. And I personally would be waiting to see the RUT fail about 1152.45, the swing low point here. And even though that'd be far from calling the high, you've got to understand the small cap stocks I like to trade personally are higher price small cap stocks like Zillow and Yelp that have very small floats. So when they do get a reason to break out to either side, they move quicker. And I wouldn't really care if I called the high if I waited for the point that would produce a higher probability of winning trades and a higher probability of larger profiting trades. And I'm willing to wait for that for the opportunity to go short on those. Otherwise, you still got to kind of wait for a little bit of a market pullback, 1173.18 area on the Russell 2000. And that area would just indicate if we made a positive move from it, time to enter your next swing trade to the long side. We're going to go over now to the NDX. That's our NASDAQ 100. And we had the momentum trade from the breakout here 3 or 4 weeks ago, and it's pretty safe to say, my little saying, when the Momo is no mo, get out. I think it was time to get out early in this past week. We still have our support point of the prior weekly swing highs of 43.37.78, and again here at 42.78.14. And a couple potential pullback points, which again would still be bullish indications if we were to come down to them and make a positive move from. Those would be 42.85.82 and 42.15.73, either which would be a bullish indication should we hit them, make a positive move, and start upwards again. It's really hard at this point to determine an upwards target because we would have to either confirm further pullback to get our next low or break this swing high point and depend on our longer term target area around 47.25.71, which if these longer term target hits, the ones that I've talked about on the S&P and the DJI over the past few months, I think that would still come probably towards the end of May before the traditional summer sell-offs. Now, one thing I want to go over here is the COMP, which we don't usually cover in the market overview video. This is the NASDAQ composite, the overall NASDAQ, basically, if you think about it this way. In this past week, the big news thing on Monday was NASDAQ's over 5,000, and it basically pulled back every day after that. What I want to show you here is these vertical lines and the source for it. These are my Fibonacci time series. It basically uses the Fibonacci equations to mark series of time. And this green line up here on my chart is the highest weekly close obtained by the NASDAQ before the 2001 tech bubble crash. Now, I've got a couple series of lines, which are long-term lines that finally hit some points way over here that were marked from the time series created between the 2001 tech bubble and the start of the 2008 tech bubble, and also another series from the low after the 2001 crash into the high before the 2008 tech bubble. So I'm going to zoom this chart in a little bit better again so we can see it, and you'll actually see that this 100% line right here, which would be one that indicated the potential at a market top, not the market all-time high top as in it's never going to go higher, but a market top point to have been made this past week. And if you broke it down on a daily chart, it was actually to be made on Monday, the day it did it, and started pulling back after that. Now, if these Fibonacci time series hold true, then it's telling me the next market low point will be the week of March 23rd. Now you can see this trend line I've got, nearly every bottom hit it except for that little debacle we had in mid-September to mid-October where we dipped below that trend line, but every other one of them held and bounced off this area. Now, if we're going to remain in this bullish pattern off of this gold trend line right here, I believe that over the next couple weeks, we'll see it settle down around there, or at least a market low point that it'll give us around that week of March 23rd. And that'll be the point that we have to watch to see if it makes an upwards move from or continues falling. If it continues falling, then we probably have until the end of the summer where we don't just make one red candle down here. We make a series of red and green candles in an overall downtrend that gets us down into these trend lines. The ironic thing about these trend lines here is these three trend lines mark the three levels of QE. Over here was when QE3, also known as QE Infinity, the $85 billion bond buying program by the Fed, was approved, and it started a new trend line. That's when this trend line started. But you see, even though that came to an end in October, there's still two other QE programs that are much low or much larger, totaling over $700 billion in monthly bond buys, that are actually annotated by these two lines, the start of QE1 and this middle one, the start of QE2. So now that we've gotten rid of QE3, that's why I was kind of suspicious back in September, October when we failed the QE3 trend line at the same time QE3 stopped, that we could work our way down to the QE2 trend line, which is still an active quantitative easing stimulus program. And, the market kind of faked me out on that. But there was good reason here for me to have believed that. The similarities of the fact that it failed that trend line the same time we failed to continue QE3 says, hey, well, maybe we got to work our way down to the QE2 line. Now, I think that if we fail that line again, we'll probably have to look at a longer term series of lows and highs that are made in a sequence of lower lows and lower highs until we catch that QE2 trend line. And I think that's a very, very safe and logical assumption to make. But again, even though QE3 has ended, there's still been no raise to the interest rates, which to me personally seems like it could be damaging to the stock market. The longer it goes, the more risk we have of getting into deflation, and the more risk we have of being like Turkey or Argentina had to do last year, where they hit those dangerous levels of deflation and had to instantly skyrocket their interest rate instead of easing into a raise of it slowly in a way that doesn't completely kill the markets. And if we get stuck in that situation, then we could see it project downwards quite a bit quicker. If the Fed is smart, well, if they were smart, they would have already started slowly increasing the interest rates. But because they're not, if they eventually get a little smarter, they will start easing into an increase in interest rates as opposed to just attacking it all at once, which would actually make them the root cause of a market crash. So eventually, we're going to have to see a raise in the interest rates. If they were smart, we would already be seeing them. And if they want to cease being stupid, we will start seeing them soon in a smaller rate that doesn't have a huge effect on the market. And if they continue to be dumb, which sadly, when you see the government, you kind of have to expect any agency within it's probably going to be dumb. It'll all be a reactive scenario, not a proactive scenario. And they could cause at least a market correction, which would get us down to that QE2 trend line area. So let's keep an eye on this trend line overall for your long-term investments. Use that trend line, let it serve as your stop point. You don't need to panic out of them now because, hey, as long as it holds that trend line, nothing I said applies. But these are just a couple things to be looking for over the next few weeks that could determine the power that the market might have overall to continue upwards, or the thrust it might make in the downwards direction. Because again, stocks don't go straight up and straight down. But one thing you can clearly see is when they go down, they typically go down faster than they go up, even if they're going to continue upwards in the longer term. What I mean by that is the red candles average being bigger than the green candles, to simplify it as much as possible. This is Coach Mike from winningstockcoach.com, wishing you the best of luck in your upcoming week of trading, and God bless.